At Astute Investment Management, we talked about fixed income a lot in 2022 and 2023, and for good reason. In the period from November to March, the VT Astute funds performed strongly, with performance bolstered by the increased allocation we had to fixed income or bonds. The VT Astute Conservative Fund, which is our fund with the largest allocation to fixed income, returned 9.73% since the start of November and 10.32% since inception. In this highlight from our November quarterly commentary, we'll look back as Dr Scott Osborne discussed why we believed, and still do, that bonds are back.
You touched on bonds, and that's something that we've talked about previously, so I wonder if you could delve a bit into what characteristics about bonds specifically make them good for investing in now.
Yeah, okay, yeah, so I mean, I guess that's a fair question in terms of we've been talking about bonds for a while now. In fact, we've probably been going from an underweight to overweight bond position, started that, maneuver this time last year. But if you look at where bond yields are, and when I say bond yields, that's kind of like, we say that what you get paid to lend to somebody. So like I said, the 10-year bond yield in the US got to 5%. What that means is that you get paid 5% a year to lend your money to the US government, and that's a high yield. The inverse of yield is price, right? So when I'm saying yields are high, you're also basically saying prices are low. And then if we look through history and answer that very narrow question of why are bonds attractive now, if you had bought bonds at today's prices throughout history, so again, when I say prices, if you bought bonds at yields where they're similar to today's yield, although actually yields have come in a little bit, you have always made better returns than the historical average. And it becomes a bit of a no-brainer. If you take treasuries first, for example, US treasuries, I think the numbers we did, if you'd bought them at any time since the early 70s at a 4.8% yield, which is about where we were adding to our positions, your sort of 12-month ahead return almost doubles, and it gets into double digits. So it's got something like a 6% historical return to something more like a 10% historical return. And that's just in the next 12 months. So when the market says to us, here is now US government bond, zero risk of a default, albeit debt ceiling stuff is kind of a arbitrary risk. It's not real default risk. So there's no real credit risk on it, and we're going to pay you 4.8% no matter what. And then you say, well, actually, every time in history where this kind of market has occurred, I've made 10% in the following 12 months. Yes, I'm very attracted to that asset class. And then folding into that again, this interest rate and inflation debate, another really strong reason why we're positive on bonds here is that if you look at bond market returns after every interest rate hiking cycle that we've had in recent history, and we can use UK data here, so you're thinking like every time interest rates have peaked in the past, so through the noughties and early 90s, if you pick the point where interest rates peaked and then looked, okay, how did UK government bonds do after that peak? They always outperform cash, and generally we're actually making double digits again on UK government bonds. And not to labour the point, but these are essentially risk-free bonds. There's no credit risk involved in them. So if you can earn a 10% return on that, it's very attractive, and that's why we are drawn to bonds at this phase of the cycle. And then the final point on that is that regardless of the potential upside return on those bonds, the best case scenario for them in terms of total return, i.e. just how good could the return get on them, is that the economy crashes, right? Because if the economy crashes, then central banks are going to slash rates very quickly, and that's when bond prices will go up a lot. So it's not like we actually even think we're going to get that environment and we'll make the best level of returns from these, but the fact that they do give us that diversification benefit should a really bad recession occur is just like a really is like a cherry on top of the investment case for them, because it allows us to then continue to have that slight risk on bias in our equities, which we talked about a little bit earlier. So yeah, you combine the fact that versus history prices are very attractive, versus this economic rate hiking cycle, the timing is very attractive, and the fact that we get this brilliant level of diversification should a downside scenario materialize. For us, it's just a bit of a no-brainer at this point to be in the bond market, and it's exactly why even as interest rates have gone up and cash looks more and more attractive, we have been reducing cash levels where we can and basically putting that into fixed income assets, because we're confident that we'll get better returns there, even over relatively short time horizons.
Whilst we've seen a strong performance from bonds over the period from November to March, we still believe that there is further to run. Although interest rates are unlikely to drop back to the low levels of the post-financial crisis era, an environment of falling inflation and interest rates should be positive for bond prices. See you next time.